Howdy, Jacob here. Today we're looking at American Axle and Manufacturing Holdings in the automobile components industry. Quite a bit of net debt here, just under a billion market cap on over 3 billion enterprise value. Growth is looking like maybe 3 to 5% annual growth rate, and margins are down on both the gross and operating margin sides. So we get to see increase in revenue of maybe 40%, and margins on the gross profit is slightly up. Operating profit is actually down from 10 years ago. Now we're wanting to see, we also see that in the mid 2010s, high single digit, low double digit return on invested capital to low single digit, even negative some years. They're not even producing positive earnings. The balance sheet shows 520 million cash on hand with 2.7 billion dollars in long-term debt. That 2.7 billion dollars in long-term debt is quite substantial. Let's say 270 million 5-year average, it's 10 times that. So they have, it would take 10 years to put 100% of their 5-year average free cash flow towards debt, which is a concern. I mean, the debt is very likely due before that 10 years is up. And so they're just going to have to refinance. And it gets to a point where your indebtors don't want to refinance to you, and then you have to sell assets. It does not get pretty. And so that's quite a bit of debt. Take that in consideration when you do your own analysis. Understand that your present value calculation doesn't necessarily take into consideration debt exactly, but you can put it in by tweaking some of your discount rates or maybe terminal values to be based more on enterprise value than market cap. But to view the company, we see that a lot of their money goes towards debt reduction. I mean, there was fairly large net acquisition in 2017, and then since then, almost all of their free cash flow is going towards debt reduction. There's a tiny bit of share repurchases, tiny bit of net acquisitions, but really 90+% of that free cash flow the last 7 years, 6 years is going towards debt reduction. So, I mean, yeah, think about that too. That means the money they're making, they're not going to be able to reinvest. They're not going to be able to grow that faster. And so debt reduction is good in the fact that it makes a business less liable, less leveraged, less risky from that standpoint. But it's not going to grow as much as a company that has no debt and can utilize all their free cash flow to acquire companies efficiently, repurchase shares, pay a dividend, or most importantly, with a high return on invested capital, invest back into themselves. So let's start making some assumptions here. I would say I'd probably be pretty comfortable with 3% growth rate, very low on the PE, price free cash flow, because their enterprise value is so much higher than their market cap. Margins, I'll probably lean closer to the free cash flow side here. Um, I mean, even then, let's go 2 point. Let's go two. I need to do a bigger range than that. So the reason I did such a big range too, I mean, that debt figure, and I haven't said this in quite a couple videos, but $2.7 billion, 1% of that, 27 million, 2%, 54 million. So, I mean, if you had an increase on your debt, let's say your debt is variable, it increased 2% due to interest rates being 2% higher than when they initially set them. I mean, you're looking at digging into 25, 30% of that free cash flow. So to me, I think I'm comfortable with this. I mean, this 2% is a huge reach here, but um, that's fine. I think really. So if I were reading, so I'm actually going to change this. I'm actually going to go towards even way lower. So this might seem very confusing, but a 6p in price free cash flow. I'm doing that because their enterprise value is it's over 3 times their market cap. And so I've been trying to take into consideration more debt into my present value calculation. And you can do that through a discount rate. I think that's appropriate. But I also think it's appropriate to do based on their price to earnings, price to free cash flow. Because if they were the next 7 years to reduce that debt figure down to maybe 3 to 4 times, um, 3 to 4 times their average free cash flow yield, then they should be in a comfortable position to get back to a 10 or 11 PE with a 1 to 2% growth rate. So I think that based on what I'm seeing, I'm pretty comfortable with that. For share change, let's just say they offset stock-based compensation. Both were about 10 million. Pretty comfortable with that. So, I mean, again, it looks weird to see that 6P in price per cash flow, but again, what I'm saying is my analysis. I'm basing their uh, terminal value on their current enterprise value, and even if they reduce quite a bit over the next 7 years, I'm going to be conservative and not reduce the discount rate, but rather, or increase the discount rate, but rather decrease the terminal value. So with these assumptions, I mean this would basically just mean like I don't feel comfortable investing in this company. They would have to be selling for dirt dog cheap to where I'd really have to be able to maybe even I could maybe buy when a price to book is 0.5 and I were to review the assets and know that they are very hard assets. You could sell them for maybe 90 cents on the dollar. That'd be comfortable. But based on a 1.4 price to book, that much debt, um, it's just going to have to fall a lot more for me to want to do a review on this company and for me to even think about investing in it. I do hope you enjoy the video. I just wanted to further explain some of my assumptions, as I know a terminal PE looking like that seems a bit wonky, but just to give some light around, shed some light around it. But I hope you enjoy the video. Have a great rest of your day.